Hi everyone, and welcome to the Buffett and Beyond Stock Selection Strategy, and it's based on the book Buffett and Beyond by Dr. Joseph Belmonte. And remember folks, if you want to live on the beach like Jimmy Buffett, you really have to learn how to invest like Warren Buffett. And Buffett and Beyond proudly presents to you the good, the bad, and the ugly. And remember folks, the good stock should be in our portfolio, the bad stock should be in somebody else's portfolio, and the ugly stocks should be in nobody's portfolio. And here we are at Stock Analysis of the Week, and we're going over Constellation Brands, which is an old friend of ours. And Constellation is a leading international producer and marketer of beverage alcohol brands with a portfolio of wine, spirits, and imported beers. And it acquired B.R.L. Hardy, which is Australia's largest wine producer, in 2003, acquired the Robert Mondavi Group in 2004, and the Svedka vodka brand in 2007. Consists of two business units, the Constellation Brands North America, which is 93% of sales, and all others, which is in Canada, Australia, and Europe, which comprises 7% of sales. Has about 8,700 employees, and the Sands family owns 8.1% of the business, and the Sand family runs the business. Now, let us look at the numbers, and the first thing we want to look at is that clean surplus return on equity, and you can see it's been around 20% for the last 4 years if you include the projections for 2019. Now, the clean surplus return on equity is configured totally different than the traditional accounting return on equity. And the clean surplus return on equity is an efficiency operating ratio. Now, let us look at this net income over here, and I want to show you 2017. And the 2017 numbers have been upgraded just recently, up about 4% from their projections, and 2018 up about 4% from previous projections. And 2019, now the new projections are out, and these are not out by the company, these are out by analysts right now. So when you look at our computer program, you won't see this 2019 number for another several weeks yet, because the company has not said one way or the other whether these projections are in their own forecast. Now, I want to show you something over here. Let's look at the retention rate. The retention rate is how much of the money the company is making that is put back into the company. So in other words, let's look at the projection for 2019. It's 79%. That means 21% of the money it's making is paid out in the form of dividends. And you can see right up until 2014 and including 2014, this company was taking all the money it was making and putting it back into itself in order to grow. And what we don't care about this company, even though we love the company, what we don't care about it is that it is starting to give some of the money out that it is making in the form of dividends, which means its growth is slowing down. However, back to this clean surplus return on equity, with a 20% ROE, that means that the net income and earnings are growing at a very, very consistent rate. Now down here, when you see the ROE was increasing, that means the earnings were increasing at an increasing rate. In other words, it's like a race car on the track that's going faster and faster and faster. And then up here, when you see an average rate of about 20% consistently for about 4 years, that means the race car is just going very, very fast at a consistent pace. And the market does like that, folks. Now, let's look over here and let's look at the net income growth. Now, remember what net income is. Net income is the earnings minus the future liabilities of the company and the non-recurring items, such as the sale of a strategic business unit. So net income is really a very, very good number, which is used to compare one company to another, no matter what industry it's in. And that's such an important part, folks. That's why we use net income, which is very, very difficult to find on the income statement. You have to look for all those footnotes. But anyway, back to the net income, we're looking at 12.7% growth in 2019. Now, in our database, the net income growth for our 600 or 700 stocks that are in there is only about 3.1%. Now, this is not earnings growth. This is net income growth, which is much more important. So this company is growing its net income at a much faster rate than the average stock in our database. And our database includes the S&P 500 stocks plus another 150 to 200 stocks that we consider worthy of analysis. And the revenue growth for 2019 is speeding up a little bit to 8.7%. And folks, we like that very, very much. So we like these numbers. This company is in our growth portfolio for some time now, and we're keeping it for next year. You can bet on that. And let us look how the company how the stock has performed over the past 1 year. And it's up about 27%, which is this rusty colored line, versus the market, this black line, which is up about 12%. So this company is outperforming the market on a 2-to-1 basis. And looking over the past 5 years, it's up just about 350%, while the market is up about 65% or so. So it is outperforming the market by about 5-to-1 on a compounded basis. And once again, looking at these numbers, we see this nice high clean surplus ROE around 20%. And that's the threshold to be in our portfolio, is around 20%. So we like everything that we see about this company. And once again, as I mentioned, this company is in our 30 growth stock portfolio and doing very, very well for us. So yes, we will probably keep this company in our portfolio for 2019, but we won't know that until December when we come out with our 2019 portfolio. But for now, we can't complain about this stock, and I wish we had 30 more like it. And remember, folks, if you want to live on the beach like Jimmy Buffett, this is a pretty nice beach. If you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. So, folks, it's been a pretty good week. You have a great weekend, and we will see you next time. Bodies in the sand, tropical